Hi, I'm Pattu from FreeFinCal. Today, let's talk about the second tranche of the Bharat Bond ETFs. These are ETFs maturing in 2025 and 2031, and why you should not be thinking about buying such products. So, they will be available for purchase from July 14th to 17th, 2020, and then after that, they will list on the exchange, and after that, you can buy. So, what is Bharat Bond ETF? Bharat Bond ETF is a passively managed, fixed maturity, open ended bond exchange traded fund. It is tracking an index called the Nifty Bharat Bond Indices that comprises of AAA rated government owned entities. The whole idea of a Bharat Bond ETF is like it's designed like a fixed maturity plan, but it can be freely traded in the exchange. Fixed maturity plan in principle can also be traded in the exchange, but it's in practice it is not. But this is meant and designed for free trading. So how does a fixed maturity bond ETF work? So it will have a basic fixed maturity in date and date in mind, that is after. So they will say that the ETF will mature, that is it will cease operations after 3 years, after 5 years, after 10 years, after 11 years, whatever it is. And the fund manager will track the Nifty Bharat Bond Index, and the Nifty Bharat Bond Index will have a separate index for a 3-year ETF, separate for 5-year ETF, and so on. And each ETF will contain bonds that will mature within the maturity date. So for example, let's say 5 years, it will mature, all the bonds will be such that it will mature within 5 years, or to be precise, it will mature within 12 months of the due date after 5 years. And once they mature, all the money will be put into T-bills, that is in the index I'm saying. The index will have T-bills, and they will have overnight bonds, and that will also reflect in the ETF portfolio. So this is the basic idea. So the basic idea is, they will, if they have a 5-year maturity, they will buy bonds that will mature in 4 years, 4.5 years, 3.5 years, and so on. And they are, as and when they mature, they may choose to buy a newer bond for 6 months or one year, if I mean, depending on the circumstances, how much time is left for the maturity. Or if there is not more than 12 months left, that is it's in the last year of the maturity period, then they will simply move it to government bonds and cash. So that's essentially how the fixed maturity bond ETF will operate. Now the basic idea is, they want to if you buy and hold, it will eliminate interest rate risk, and it will also more or less eliminate credit rating risk, because the credit rating for these bonds are next only to government bonds. You can assume that at least for the short term, there will not be much of a credit problem. So if you buy and hold, then there's not much of a issue. But the question is, should you even buy and hold? So the new Bharat Bond NFOs are the 5-year NFO, which is maturing in 2025 and 2031. That's a 11-year ETF. The indicative yield is 5.65% on the 5-year and 6.76% on the 11-year. Those are fairly, I would say, not exciting enough numbers, but that's because it's a AAA rated portfolio. If you buy AAA rated portfolio, you will get less returns. That's the whole point. And these are only indicated returns. Depending on what happens to the companies, the payouts, how the bond portfolio changes, the yield will also change. But that's kind of, you get an order of magnitude. That's also, you're not going to get 8% from this ETF. That much is for sure. So there are two existing Bharat Bond ETFs. One is a 3-year Bharat Bond ETF maturing in 2023, and the other is a 10-year one, which is maturing in 2030. And they were launched to much fanfare in December 2019. So the Bharat Bond ETFs are always going to be taxed like any debt fund, and I'm not going to talk about that. You need a demat account to invest in the ETF, like always. But if you don't have a demat account, or you don't want to use a demat account, you can buy a fund of fund run by Edelweiss AMC and pay a little extra. So it will start with investing only in AAA rated bonds, but there can be a fall in the AAA rating. If it goes to AA, that doesn't mean they will exit the fund. That's not true. only if the fund falls below the, only if it is, what can I say? Let me let me read that. I forgot. The I lost my train of thought. I'm getting old. So if the if the fund falls from AAA to AA, they will not immediately replace it, but they will only replace it in the next quarter, in the next rebalance. So it's there will be a drop in the NAV and so on. But of course, that is a consideration for people who are buying and selling in real time. That is, they are trading in the bonds, and of course the indicative yield will also change. Please recognize returns are not guaranteed, principal is not guaranteed. Like I said, indicative or predictable returns is not true. That's all nonsense. If you are going to consider risks of the Bharat Bond ETF, if you want to buy and sell freely like a trader, then you must understand credit risk is there, but it's small, but it's there. Interest rate risk is extremely high. In March 2020, the 3-year ETF fell by 3%. The 10-year ETF fell by 5% because of supply demand imbalance, and RBI liquidity had to be infused. Then only the NAV moved up. Then there is also a huge price to NAV disparity. There's a liquidity risk in the ETF. The 10-year ETF had a 2% deviation for a week in April 2020. The 3-year ETF had a 1% price NAV deviation for almost 3 weeks in May 2020. So trading is not very frequent. You have to be careful. And if many retail investors buy, they are only going to buy and hold. That means the liquidity will not be there for the ETF. So please be very careful. Don't assume that you can trade freely. Then if you want to buy and hold for 11 years, it's just stupidity, because you can't do any kind of portfolio management. You can't rebalance if you're going to buy and hold. That kind of decision is stupid. A much superior option to this is buying a gilt fund, open-ended gilt fund, doing an SIP in it. Simple SIP in gilt fund. You can do portfolio management. Okay, there goes the camera. You can do portfolio management. Also, long-term SIPs have been very productive. And for those who want to buy and hold for 5 years, the current yield, and if you consider indexation, the post-tax return would be about 4.6%. If you are on the 20% slab, the post-tax 5-year SBI FD is only 4.3%. So you can might as well invest in SBI FD. And post office is giving you much higher 6.7% before tax, and RD in post office is 5.8%. So clearly, there's no benefit in buying this, and if you are a senior citizen, you will get 50,000 rupees interest income exemption in the income tax if you buy FD. So and RD. So clearly there's no point. And if for long term or even short term means 5 years, 20%, 30% slab guys can buy a proper arbitrage fund. They'll get 1 lakh tax free. So you leave institutional investors to buy these bonds for their insurance products, pension funds, and so on. Better for retail investors to leave this alone. Thank you. Bye-bye.